Hey everyone, how's it going? It's Dan Russo, Chief Market Strategist at Chaikin Analytics. Hope everybody's having a great week so far. Holiday shortened week, only 4 trading days, but it's Wednesday, so it's still a midweek market update. Hope everybody's doing well. Here's kind of what's jumping off the page at me in the first couple of days this week. Number one, we are back to a situation where all of the major market ETFs for equities here in the US, by that I mean SPY, IWM, and Qs, kind of the big three that you look at to assess the landscape, all back to overbought conditions based on our overbought oversold indicator that we use here at Chaikin Analytics. So interesting dynamic. How do we think about it? We've talked about this. I'll mention it again. Overbought within the context of an uptrend, right? What's the trend? Up. Where are we within that trend? We're overbought. What does that mean? To me, I like to utilize overbought, oversold to think about calibrating aggression. Do you want to be really aggressive when you're overbought in an uptrend? Probably not, right? Oversold in an uptrend, different story. Right? And you can flip that on its head if we do begin to roll over, and we will at some point. Same applies. Do you want to be aggressive, lightening up when you're oversold within a downtrend? Probably not. You want to use overbought in a downtrend to think about that, or to even think about adding bearish exposure. What that means to you is something different. Obviously, this is not personalized financial advice in any way, shape, or form. Only you know your situation, your risk tolerance, what the structure of your portfolio is, and where things fit within that framework. And I think that's something that's interesting. I think a lot of people talk about ideas and idea generation, and there's no shortages of people putting out good content and good ideas, but it's always kind of important for you, me, anybody who's reading these ideas to think about where they fit within the context of your entire portfolio. You might see somebody put out a great idea on a semiconductor stock, right? Maybe somebody's talking about NVIDIA, which is, maybe in the process of breaking out of this consolidation that it's been in since September. That might be great. But what if you already own 5 semiconductor stocks? Does NVIDIA fit? Maybe. Or do you have to make room for it? I don't know. But to just blindly add it without thinking about what that does to your portfolio, what that does to your current exposures, I think would be a mistake. I think it's important to understand where things fit in. Bigger picture too. What if you're a building developer? What if you're a building developer and your job is to, buy properties, renovate them, develop them, multifamily dwellings, and then rent them out? If you then read about a great idea in the home builder space on a stock, where does that fit into your life? Where does that fit into your portfolio? I don't think a lot of people think about it that way. And it's part of, kind of being, doing the work and wanting to learn about investing as opposed to just, being told what to do. But anyway, I digress. That's just something that was on my mind, and I like to speak my mind on these calls every now and then, or these videos. But simply the fact of the matter is we're overbought within the context of an uptrend, which is fine. That happens. You want to see that, actually. As somebody who's bullish, I love seeing the market get overbought within the context of the trend that favors my view. That just makes a ton of sense. So we're going to continue to watch every day in my notes, which are available. Head over to chaikinanalytics.com /test drive. You can sign up for a free 14-day trial to read my notes 5 days a week. Within this framework, and I was highlighting it today, you just kind of simply say to yourself, we're just overbought within the trend. From there, we start to think about what are some of the other dynamics at play. And what's jumping off the page at me today, in addition to the overbought nature of markets, equity markets, is rates backing up. Everybody's talking about it, right? I don't have a differentiated view here other than to say we've been bearish treasuries for a while. If you look at our model, our ETF model at Chaikin Analytics, we turned bearish treasuries months ago and turned bullish on the riskier parts of fixed income months ago. All right, so that theme is largely playing out, but now we have to start to connect those dots and think, what does this mean for the equity market? And my view on this is might not be what you expect. A lot of people say higher rates bad for equities. Not necessarily the case, right? Why are rates moving higher? I think rates are moving higher because things are getting better from an economic standpoint. The retail sales number today is a case in point, and it's just one data point of many. Right, so if rates are moving higher because the economy is getting better, right? Not necessarily the worst thing for equities, in my opinion. And we've been on this, right? Go back to my work on the copper gold ratio, everything that I write about and talk about, we've been all over the inflation/reflation theme, right? So this is not new. This is playing out. This is what we would expect to see. But now the 10-year is actually backing up to the point where we're getting close to where we were pre-pandemic. And the question now becomes, how far will the Fed let it go? Does the Fed let it go to 2%? We're at about 1.3 right now on the 10-year. Does the Fed let it go to 2%, 1.5%? I have no idea. And it doesn't matter, really, in my opinion. What matters is the path. How fast do we get there? Do we get there in a gradual pace? If we get there at a gradual pace due to a recovering economy, I think the equity market can absorb that, right? Might be a headwind for some of the growthier areas of the market, high multiple stocks with earnings way on the come, fine. But we've already started to see that. And it could be a tailwind for the reopening reflation ideas, fine. But we're already starting to see that as well. I think the risk to the market is we get there quickly. And that's not my call. I have no idea how fast we could get there if we're going to get to 2% at all in the 10-year or even beyond. But if we quickly go from 1.3 to 2, equity market's probably not going to like that. So it's not as simple as rising rates bad for equities. I think it's path dependent, like anything else. So we're going to continue to map it out. We're going to continue to look at the key levels and continue to think in terms of if-then scenarios, probabilities, right? No forecasting, no prediction. We're not in the prediction game. We're in the probability game. I have no idea what's going to happen tomorrow. I have no idea what's going to happen in the 10 minutes after I record this video. So certainly no predictions, but certainly probabilities. Right now, odds favor continuation of the upside in equities, and we're going to continue to stay on the right side of that until the weight of the evidence supports having a different view. Until then, be well, be safe. We'll talk to you soon.